be frank!
Welcome to Let's Be Frank, the weekly podcast that gives a quick take on U.S. stocks from the perspective of a value investor. I'm Brian Frank, a professional investor with over 20 years of experience specializing in small and mid-cap stocks. Every week, I'll cover what is working, what isn't working, and talk about the value we're finding on the hunting trail. Find out more at frankfunds.com. Now let's get to it. Today is Friday, August 21st, 2026. Rates on U.S. treasuries caught my attention this week, with the 30-year U.S. bond peaking at 5.3%, declining below 5.2% on an intervention from the U.S. Treasury, and then resuming its march higher, ending the week at 5.27%. Why is a stock guy focused on yields? Well, I'm an absolute value investor. That means I only buy stocks when the numbers justify taking the risk. You can have the greatest company in history, but it is still more risky to own than a U.S. Treasury. An absolute value investor looks at the risk-free rate available in U.S. Treasuries and uses that as a true north to price risk. With U.S. Treasuries yielding more than 5%, that means the hurdle to own risk is far greater than a 5% annual return. With the cyclically adjusted price-to-earnings ratio now over 40 times, if you invert this, that is roughly a 2.5% net earnings yield. That is dangerous. As a stock picker, I can work around that, staying on the hunting trail until I find earnings yields far greater than treasuries. But index investors are out of luck. As most of the investing world is now indexed, I fear these investors will have to learn the lessons of absolute value investing the hard way. Prices on stocks may eventually correct to the extent that you get a better earnings yield than U.S. treasuries, as you should because they're higher risk. We'll see what happens. In the meantime, let's move on to what worked in value. It was a quiet week on the tail end of earnings season for my portfolio, but what stood out was our allocation to healthcare stocks. I started this year with 0% invested in healthcare, and as of today, nearly 10% of my portfolio is in this sector. This week, Moderna and Merck made an exciting announcement showing breakthrough results in treating cancer in a novel way. Though this study has been in the works for years, some participants are expecting further scientific acceleration as these companies implement AI. One of the qualitative reasons we own healthcare is just this. I think AI investing will move from picks and shovels like memory and semiconductors to the actual beneficiaries, and it seems clear that healthcare companies will benefit in a big way. This means more clinical trials, more medical supplies, more breakthrough drugs, and better health for everyone. It's nice to be on the side of progress while making money for shareholders. What didn't work? Independent power producers suffered this week on a series of announcements from governors in Texas and Pennsylvania, making it more difficult for data center construction. Though I am disappointed, I think the market has priced the IPPs well below their baseline earnings cases, and everyone seems to forget, even without data centers, we are still structurally short electricity, with large uses coming from more electric cars and reshoring of factories as well. I want to be careful here to avoid thesis drift. The call option of additional power purchasing agreements from data centers may be off the table for IPPs, but I've done my valuation work on what is in front of these companies on an existing basis, without assuming any additional manna from heaven from the hyperscalers. Next up is on the hunting trail for value. With my portfolio as well as its benchmark index, the Russell Midcap Value, making year-to-date highs this week, the urgency to replace fully valued companies with more compelling opportunities is rising. I have been on the hunting trail, looking through various value message boards, substacks, and screening the market. Happily, I have some work to do this weekend, having found some unloved companies in consumer discretionary and healthcare. I've noticed the cheapest valuations are getting some bids in this market without regards to quality. That tells me investors are rotating from the high-flying stocks and wary of the 40 times cape I spoke about earlier. However, these are early days. As the rotation continues, quality value should outperform, and that would be the sweet spot for my portfolio. Wrapping up, U.S. Treasuries are telling investors to demand a better risk-reward, but at the moment, index investors are ignoring this warning. The AI cycle's next leg could be shifting from picks and shovels to actual beneficiaries like healthcare companies. Finally, we see some money coming into the lowest valuations, but these flows are agnostic when it comes to quality. Ultimately, I believe quality value will wear the crown in the next part of this cycle. Thanks for listening and have a great weekend.
Performance data quoted represents past performance and does not guarantee future results.
The investment return and principal value of an investment will fluctuate so that an investor's shares, when redeemed, may be worth more or less than their original cost. Current performance may be lower or higher than the performance data quoted. You may obtain performance data current to the most recent month end by calling the Frank Value Fund at 1-888-217-5426 or visiting our website at frankfunds.com. Returns include reinvestment of any dividends and capital gain distributions. Non-FDIC insured may lose value. No bank guarantee. The fund's investment objectives, risks, charges, and expenses must be considered carefully before investing. The prospectus contains this and other important information about the fund, and it may be obtained by calling 1-888-217-5426. Please read it carefully before you invest or send money. This publication does not constitute an offer or solicitation of any transaction in any securities. Any recommendation contained herein may not be suitable for all investors. Information contained in this publication has been obtained from sources we believe to be reliable, but cannot be guaranteed. The information in this publication represents the opinions of the individual portfolio manager and is not intended to be a forecast of future events, a guarantee of future results, or investment advice. Also, please note that any discussion of the fund's holdings, the fund's performance, and the portfolio manager's views are as of the recording date and are subject to change without notice.